Have you ever looked at the news and seen headlines about national debt? The numbers are staggering, often in the trillions. The US, Japan, China, European nations, it seems like almost every country is in debt. This brings up a really interesting and, frankly, a very confusing question. If every country is in debt, who exactly are they all owing money to? Who is the world's creditor? Are we all just passing IOS around in a circle? Let's unravel this economic mystery together. First, let's get one thing straight. The idea that every single country is in debt isn't technically 100% accurate. There are a few very small, often resource-rich nations that might have zero or even negative net debt. But for the vast majority of the world's economies, including all the major players, being in debt is the norm. So, the question remains valid. To understand who the creditors are, we need to break down what national debt actually is. When a government spends more money than it collects in taxes, which is called a budget deficit, it needs to borrow money to cover the difference. It does this primarily by issuing government bonds. Think of a bond as a formal IOU. You buy a bond from the government, and in return, the government promises to pay you back the full amount, plus regular interest payments, by a certain date. So, the real question is, who is buying all these bonds? The answer isn't a single entity or a shadowy figure in a secret lair. The creditors are a diverse group of individuals and institutions, both within the country and outside of it. Let's start with the domestic creditors, the people and organizations inside the country itself. A huge chunk of a country's debt is often held by its own citizens and institutions. This might be you, your neighbor, or your pension fund. When you invest in a government savings bond or your retirement plan manager buys government securities, you are essentially lending money to your own government. Why do people do this? Because government bonds from stable countries are considered one of the safest investments in the world. The government has the power to tax and print money, making the risk of default extremely low. So, in a very real sense, a government often owes a lot of money to its own people. Then we have domestic institutions. This includes commercial banks, insurance companies, investment funds, and even a country's own central bank. Banks buy government bonds as a safe way to park their cash. Pension funds and insurance companies buy them because they need stable, long-term investments to meet their future obligations to retirees and policyholders. Now, let's talk about the central bank, like the Federal Reserve in the United States. Through a process known as quantitative easing or open market operations, the central bank can buy its own government's bonds. This injects money into the economy and helps keep interest rates low. So, in a way, the government is borrowing from a branch of itself. It's a bit more complex than borrowing from your left pocket to pay your right, but it's a significant part of the modern financial system. When you hear about the Fed's balance sheet, this is largely what it refers to: the amount of government bonds and other assets it holds. So, a big portion of national debt is money a country owes to itself. But what about the rest? This is where foreign creditors come in. This is the part that usually gets more attention. Foreign creditors are governments, companies, and individuals from other countries who buy a nation's bonds. Why would another country want to buy, for example, US debt? For the same reason domestic investors do: safety and stability. U.S. Treasury bonds are often seen as the ultimate safe haven asset. During times of global economic uncertainty, investors from all over the world flock to buy them. The U.S. dollar is the world's primary reserve currency, meaning it's used for most international transactions. To conduct global trade, other countries need to hold large reserves of U.S. dollars, and buying U.S. bonds is a convenient and safe way to hold and grow those reserves. So who are these foreign holders? The biggest ones are often other major economies. For decades, countries like China and Japan have been major buyers of U.S. debt. For them, it's a strategic economic decision. They export a lot of goods to the U.S., and in return, they receive a lot of U.S. dollars. By investing those dollars back into U.S. bonds, they help keep the value of the dollar stable relative to their own currencies, which makes their exports more competitive. It's a deeply interconnected cycle. Other major holders include the UK, Switzerland, and oil-exporting nations in the Middle East who need a safe place to invest their vast oil revenues. So, to recap so far, the creditors are not a single entity. They are a mix of domestic citizens, banks, pension funds, the country's own central bank, foreign governments, and international investors. Now let's add another layer: international organizations. When you hear about countries like Greece or Argentina getting a bailout, this money often comes from supranational institutions. The two biggest players here are the International Monetary Fund, or IMF, and the World Bank. These organizations were created after World War II to promote global economic stability. The IMF acts like a credit union for its 190 member countries. Countries contribute to a pool of funds, and those facing financial crises can borrow from this pool, usually with strict conditions attached to reform their economies. The World Bank, on the other hand, focuses on providing loans and grants to developing countries for long-term projects like building infrastructure, schools, and healthcare systems. So, for many developing nations, a significant portion of their external debt is owed to these international bodies. So, we have this complex web of debt. Country owes money to its own citizens, its banks, and its central bank. It also owes money to country B's government, investors in country C, and an international fund in country D. Meanwhile, country B owes money to its own people and to investors in country A. It's not a simple one-way street, it's a global network of credits and debits. This brings us to a crucial point: the total amount of global debt. When you add up all the government debt, corporate debt, and household debt in the world, the number is astronomical: over $300 trillion. How is that even possible? It's because in our modern financial system, one person's debt is another person's asset. Your mortgage is a debt to you, but it's an asset on your bank's balance sheet. The government's bond is a liability for the government, but it's a valuable, interest-earning asset for the person or pension fund that holds it. Debt, in and of itself, is not necessarily a bad thing. It's a tool. It allows governments to invest in long-term growth, building roads, funding research, and providing education without having to raise taxes to impossibly high levels today. It allows companies to expand and individuals to buy homes. The system works because of the trust that these debts will be repaid. The entire global financial system is built on this trust. The problem, of course, is when debt grows too large relative to an economy's ability to pay it back. High levels of debt can make a country vulnerable to rising interest rates. If rates go up, the cost of servicing that debt, just making the interest payments, can skyrocket, crowding out other essential government spending. This is when countries can fall into a debt crisis. So, to answer our original question, who is the creditor when every country is in debt? The creditor is us. It's a distributed, global network of individuals saving for retirement, banks managing their assets, corporations investing their cash, and governments managing their reserves. The debt isn't owed to Mars or some mysterious cosmic bank. It's owed to millions of participants within the global economic system itself. It's a complex, self-referential system where nearly everyone is both a debtor and a creditor in some capacity. The system is designed to create wealth and facilitate growth, with each bond, loan, and credit representing a promise of future value. Understanding this helps demystify those scary headlines and reveals the intricate financial web that connects us all. Thanks so much for watching. If you found this explanation helpful, please give this video a like and consider subscribing for more deep dives into how our world works. See you next time.